The anchored VWAP is one of the best tools for finding potential entry points, especially in the stock market. While the traditional VWAP starts from the beginning of the trading day to its end, the anchored VWAP allows you to choose your starting point. This flexibility is a game changer as it lets you align the indicator with a significant market event or at psychological turning points. So we'll anchor the VWAP at a high volume bar, and this way you can track how the market behaves relative to this important level. High volume often signals strong interest in the market, and when combined with a price move, it can indicate momentum in a particular direction. The core of this strategy revolves around trading pullbacks to the VWAP lines when price temporarily moves against the main trend before resuming its original direction. Selecting the right anchoring point is crucial for this strategy. Ideally, you want to choose a point that marks a clear shift in market structure or psychology. This could also be a significant swing high or low, or a major news event. But a bar with exceptionally high volume is something special. The goal is to capture a point where the market's behavior changed significantly. So in this chart, we anchored the VWAP on the highest volume bar. This high volume shows increased participation from traders, often signaling important price levels or potential trend changes. When this high volume coincides with a strong price move, it can be a powerful indicator of market direction. Once you've anchored your VWAP, the strategy involves watching for price pullbacks to this line. These pullbacks represent potential entry points for trades in the direction of the overall trend. For example, in an uptrend, you might look for buying opportunities when the price pulls back to the anchored line, or even at the bands below the main line. This strategy can be applied to all timeframes, making it versatile for both day traders and swing traders. The principle remains the same. Identify the trend, anchor the VWAP at a high volume bar, and trade the pullbacks. To enhance the effectiveness of this strategy, you can also use the VWAP bands. These bands are typically set at 1 or 2 standard deviations above and below the VWAP line. They can help confirm the strength of the trend and provide additional support and resistance levels. When price stays consistently above the upper VWAP band, it suggests a strong uptrend. Price consistently below the lower band indicates a strong downtrend. These VWAP bands can also help in identifying potential reversal points. If the price has been trending strongly and suddenly penetrates the opposite VWAP band, it might signal a potential trend reversal. The anchored VWAP strategy aligns well with the concept of trend following. By anchoring the VWAP at this significant point and trading pullbacks, you're essentially trying to catch waves in the direction of the overall trend. But VWAP, even when anchored, is still a lagging indicator. It's based on historical price and volume data, which means it can't predict future price movements with certainty. Another factor to consider is the overall market context. This anchored VWAP strategy tends to work best in trending markets. In sideways or choppy markets, the pullbacks to VWAP might not be as reliable. Volume analysis must complement this strategy. Not only volume is important for selecting the anchoring point, but it's also key for confirming the strength of pullbacks and potential breakouts. When a pullback to the anchored VWAP occurs on low volume, it often implies a weak retracement and a higher probability that the main trend will continue. But if the pullback happens on high volume, it might indicate a stronger move that could potentially break the VWAP level. To further refine your entries using this strategy, pay attention to price action around the anchored VWAP. Look for rejection candles or other signs that the price is respecting the VWAP as a support or resistance level. This could include candles with long wicks or engulfing bars. You might also use traditional support and resistance levels, or even trend lines in conjunction with the anchored VWAP. This approach can provide additional confirmation. One approach to setting stop losses is to place them beyond the recent swing high or low on the other side of the VWAP. For profit targets, you might look at previous support or resistance levels, or at the next bands. The anchored VWAP strategies can be particularly effective when combined with a multiple timeframe analysis. For instance, you might use a higher timeframe to determine the overall trend and to select your anchoring point for the VWAP. Then you could drop down to a lower timeframe to fine-tune your entries based on pullbacks to the VWAP. We are looking at an hourly chart of a stock that has been in a strong uptrend. You notice this bar with exceptionally high volume, which coincides with a strong upward move. This seems like a good place to anchor your VWAP. Over the next few days, the stock continues to rise, but then starts to pull back. As the price approaches the anchored VWAP line, you see this previous support level, implying buyers are stepping in at this level. This could be a good opportunity to enter a long position with a stop loss placed just below the recent swing low. Now let's consider a 15-minute chart of a stock in a downtrend. You anchor the VWAP at this high volume bar, which marked the start of the current leg down. The price has been consistently trading below the VWAP line, confirming the downtrend. You notice the price starting to climb back towards the VWAP line on decreasing volume. This could be a good opportunity to enter a short trade with a stop loss just above the recent swing high. Here, the market has been in a strong uptrend. You've anchored the VWAP at a significant high volume bar near the recent top. The price has started to fall and has consistently traded below the VWAP line for several bars. You notice that each attempt to rally back to the VWAP line is met with selling pressure. This could be an early sign of a trend reversal. You might consider entering a short trade on one of these failed rallies to the VWAP with a stop loss above the recent swing high. In all these examples, anchored VWAP serves as a dynamic support resistance level and a reference point for market psychology. The central pivot range method taps into market sentiment and price action. This particular area shows where the market might turn, being like a map of support and resistance. This is the pivot. Above and below are two more lines, and all of these form a range. This range tells us a lot about what might happen today based on yesterday's activity. So when you look at a chart, you'll see the CPR as three lines. They might be close together or far apart. This distance matters because it tells us how the market might move. A wide CPR means the market might stay calm. Price often bounces between the lines, and market is taking a rest. These calm days can lead to big moves later. A narrow CPR is different. It's like the market is getting ready to sprint. When the lines are close, price can break out. These days often see strong trends. The market picks a direction and runs with it. Now let's talk about how to read the CPR. It's all about comparing today to yesterday. If today's CPR is higher than yesterday's, we're looking up. The market mood is positive. Buyers are in control. This is when you want to think about buying. But if today's CPR is lower than yesterday's, it's time to look down. Sellers have taken charge. The market mood has shifted. This is when you might want to sell. Here's a key point. The CPR doesn't just tell us about today. It hints at tomorrow too. A rising CPR suggests more upside ahead. A falling CPR warns of possible drops. Let's see how this plays out. Say you see the CPR moving up day after day. This is a strong sign. The market is in an uptrend. Each new day confirms the move. This is when you want to look for chances to buy. If the CPR keeps stepping down, we're in a downtrend. The market is showing its hand. It wants to go lower. This is when you search for selling opportunities. But the CPR isn't just about direction. It's also about strength. A wide CPR is hard to break. Price often respects these levels. They act as strong support or resistance. When you see a wide CPR, expect the market to pause. It might bounce around inside the range. A narrow CPR is weaker. Price can push through it more easily. But don't ignore it. A narrow CPR can lead to explosive moves. The market often builds energy here before a big run. Now let's talk strategy. The CPR gives you a framework for trading. It tells you where to look and what to expect. Here's how you can use it. First, check the CPR at the start of each day. Compare it to yesterday. Is it higher or lower? This sets your bias. Higher means look to buy. Lower means look to sell. Next, watch how price interacts with the CPR. Does it bounce off the lines? Does it push through? This tells you about the day's strength. Strong bounces mean the CPR is working well. Clean breaks suggest a trending day. Here's a key tactic. In an uptrend, buy the pullbacks to the CPR. The CPR acts as support. Price often bounces here. It's like the market is taking a breath before the next push-up. In a downtrend, do the opposite. Sell when price rallies to the CPR. The CPR becomes resistance. It's where the market often turns back down. Now don't just buy or sell blindly at the CPR. Wait for price to show its hand. A bounce of the CPR is good. A strong candle in your favor is better. The more signs you see, the stronger your trade. Let's talk about timing. The central pivot range works best at certain times. It's strongest at the market open. This is when big players make their moves. They often use the CPR as a reference. As the day goes on, the CPR can lose some power. By afternoon, it might not hold as well. Keep this in mind. Your morning trades might need different rules than your afternoon ones. It's all about market psychology. The central pivot range shows us where value was yesterday. Traders remember these levels, and they often make decisions based on them. Think about it. If price is above the CPR, traders feel bullish. They see the market as strong. This can become a self-fulfilling prophecy. Buyers step in at a support level. Sellers hesitate to go against the trend. When price is below the CPR, the opposite happens. Traders turn bearish. They look to sell rallies. The market develops a downward bias. Again, this can feed on itself. This is why the central pivot range is so powerful. It taps into mass psychology. It shows us what the crowd is thinking. And in trading, understanding the crowd is key. consider using the central pivot range with other indicators. Trend lines work well, so do moving averages. The central pivot range plus a trend line can be a potent combo. It gives you two reasons to take a trade. Another pro move is to use multiple timeframes. The daily CPR is great, but why stop there? Look at weekly CPRs for bigger moves, or zoom in to hourly CPRs for day trading. Each timeframe adds a layer of insight. Now let's talk about market conditions. The central pivot range works differently in different markets. In trending markets, it's a great tool for riding the waves. So buy dips to the CPR in uptrends and sell rallies to the CPR in downtrends. In ranging markets, the CPR becomes even more important. It often defines the range limits. You can buy at the bottom of the CPR and sell at the top, or look for breakouts when price finally pushes through. Here's a subtle point many traders miss. The central pivot range can show hidden strength or weakness. Say price is above the CPR, but struggling to go higher. This might be a sign of weakness. The opposite is true too. Price below the CPR, but holding steady might signal hidden strength. As you use the central pivot range, you'll develop a feel for it. You'll start to see patterns. Some days, the CPR is magnetic. Price keeps coming back to it. Other days, it's more of a springboard. Price touches it and moves away. But in the end, the CPR is about understanding market structure. It shows you where the market thinks value is. Also, you might want to mark the fresh central pivot ranges. This happens when price doesn't touch its CPR on a given day. This untouched CPR becomes a fresh CPR for the next few days. This is similar to supply and demand trading. Think of the fresh CPR as a magnet. It pulls price towards it. When price doesn't touch the CPR, it creates an imbalance, like a gap. And markets don't like gaps. They try to fill them. This is why fresh CPRs are so important. They show us where price might go next. On a normal day, price moves in and out of the central pivot range. But sometimes, price makes a big move. It might go way up or way down. When this happens, it can miss the CPR entirely. That's when we get a fresh CPR. Now here's the key. This fresh central pivot range stays important for the next few days. It's not just a one-day thing. It keeps its power. That's why you must watch it closely, as it could be a turning point in the next few days. Say the market drops hard one day. The next day, price stays below the CPR. It never touches it. That CPR is now fresh. It's a target for the market. Prices often try to climb back to it. Sometimes price might get close to the CPR. It might even have a few wicks that touch it. But if no full candlesticks form inside the CPR, it's still fresh. And why does this matter? Well, because fresh CPRs often act as strong support or resistance. If price is below a fresh CPR, that range might stop price from going up. If price is above, the range might stop it from going down. It's like a barrier in the market. You can use fresh CPRs in different ways. Some traders wait for price to reach the fresh CPR. Then they look for signs of a bounce or a reversal. Others use it as a target. If price is far from the fresh CPR, they might expect it to move towards it. The next strategy is based on the concept of consecutive up or down days in the market. When a market closes up or down for several days in a row, it often creates a specific psychological environment among traders. There's a natural tendency for people to believe that a streak can't continue indefinitely. What goes up must come down, and vice versa. That's why many traders use consecutive up or down days as a basis for their trading decisions. Now, blindly trading against these consecutive moves can be risky. It often means going against the prevailing trend and momentum, which can lead to big losses if not done carefully. That's where this strategy comes in. Instead of simply betting against any streak of consecutive up or down days, we focus on those that occur within a specific market context. The key to this strategy is understanding and respecting market structure. As you probably know, market structure refers to the overall trend of the market, typically defined by a series of swing highs and lows. In an uptrend, you'll see higher highs and higher lows, while a downtrend is defined by lower highs and lower lows. By considering market structure, you can filter out potentially dangerous trades and focus on those with a higher probability of success. For a long entry, we are looking for 4 or more consecutive down days. These are defined as days where the closing price is below the opening price. However, we don't just enter a trade because we see 4 red candles in a row. The key factor is the market structure. We only consider this setup valid if the price hasn't breached the last swing low in the overall market structure. This approach essentially turns our strategy into a trend continuation pullback play. We are looking for situations where the market has been in an uptrend, experiences a short-term pullback, our consecutive down days, but doesn't break the structure of the uptrend. This tells us that while there's been some short-term selling pressure, the overall bullish trend remains intact. The entry trigger comes from the next bullish bar after our streak of down days. We are looking for a bar that shows momentum, a relatively large candle body indicating strong buying pressure. Low spread candles, or those with wicks on both ends, are generally avoided, as they don't show clear directional momentum. Volume plays a key role in confirming this setup. We want to see an increase in volume on our entry bar. The ideal scenario is to see the highest volume in the past bars. This high volume tells us that there's significant interest in the market at this level, and if it's accompanied by a price rise, it implies that the buying pressure is overwhelming the selling pressure. In Wyckoff analysis terms, this would be considered a large effort, large result day, indicating strong demand. For short trades, the process is essentially reversed. We look for 4 or more consecutive up days, where each day closes above its open. Again, we consider the market structure. We only take this setup if the price hasn't breached the last swing high in a downtrend structure. Our entry trigger is the next bearish bar, and we want to see it accompanied by an increase in volume. The stop loss goes just above the high of the bearish setup bar. One of the strengths of this strategy is its versatility across different timeframes. While I like to apply it to daily charts, it can also be effective on shorter timeframes. However, I would recommend you to stick to higher timeframes, 4-hour and above. Another important consideration is the overall market environment. This strategy tends to work best in trending markets. In choppy markets, the consecutive up or down pattern may occur more frequently, but be less meaningful. Now here's an important tip. When it comes to analyzing volume, understand that not all volume is created equal. While we're looking for an increase in volume on our setup bar, the context of this volume matters. For example, if you see a large volume spike on a day with a very small price range, it might indicate a battle between buyers and sellers, rather than a clear directional move. This type of volume is less ideal than a volume increase followed by a decisive price move in our direction. Another nuance to consider is the relative size of the consecutive price bars. In an ideal setup, you'd want to see the magnitude of the moves diminishing as the consecutive streak continues. For example, in a downward move, the first few red candles might be quite large, but the latter ones should be smaller. This can indicate that selling pressure is decreasing, setting up for a potential reversal. As you gain experience with this strategy, you might find certain patterns. For instance, you might notice that setups that occur near recent support or resistance levels tend to be more reliable. Moving averages can be useful in confirming the overall trend and also in identifying potential support and resistance levels. A common approach is to use a combination of short-term and long-term moving averages. For instance, you might use a 50-period and a 200-period moving average. If the 50-period moving average is above the 200-period one, it confirms an uptrend, making long setups more attractive. Consecutive candles which end up as a pullback to the moving average dynamic zone are a great confirmation. First, you might see a strong trend. The price is moving up or down steadily. Then, you start to see candles moving back toward the moving averages. These are your consecutive candles. They're moving against the main trend, but not too far. As these candles get close to the moving average, they create what we call a dynamic zone. This zone is where the price might bounce off the average and continue the main trend. It's dynamic because it moves as the moving averages move. When you see several candles in a row touch this zone without going through it, that's a strong sign. It shows the trend is still strong. The price is respecting the average as a support or resistance level. This can be a great time to enter a trade in the direction of the main trend.